Okay, let's just dive right into this explainer. Today, we're taking the incredibly dense data from OneMain Financial's Q2 2026 earnings release and translating it into a narrative that actually makes sense. Earnings reports can look like an intimidating wall of numbers, but we're going to extract the real story here. We'll look at their second quarter performance and figure out what's actually driving their business forward.
So before we hit the numbers, let's establish exactly who we're looking at. OneMain Financial is a major player, specifically dedicated to offering responsible credit to non-prime consumers. Now, this is a very specific market segment, and understanding who they're lending to is absolutely essential if we want to understand their risk and reward profile. They're basically providing credit to hardworking folks who might not always qualify through your traditional prime banking channels.
Setting a super confident tone right out of the gate, Chairman and CEO Doug Shulman stated, "We delivered another strong quarter with disciplined underwriting, continued innovation, and strong execution across the business." Now, it's one thing to claim strong execution in a glossy press release, right? But as we go through this explainer, we're going to see if the hard data actually backs up that disciplined underwriting claim.
To navigate this dense report, here's our roadmap for today. We'll start with the headline results, look under the hood at segment growth, navigate the risk factors, check the balance sheet, and wrap up with the key takeaways.
Starting with Section 1, let's look at the headline results and the big numbers.
First up, the bottom line. OneMain reported a Q2 2026 diluted earnings per share of a really solid $1.32. This is a crucial metric. It tells us that despite a pretty dynamic broader economy, their core business model is still generating substantial, real profit for its owners.
And for the income-focused investors out there, they declared a very attractive quarterly dividend of $1.05 per share. When a company maintains a strong cash dividend like this, it's a massive signal. It shows management's absolute confidence in their cash flow and a direct commitment to rewarding their shareholders.
Moving to Section 2, let's look under the hood and see what's driving their consumer and insurance segment growth.
But first, we need to quickly define a metric management relies on heavily. It's called capital generation. Think of this as the real economic engine of the company. It's their adjusted net income, but it notably excludes the after-tax changes in their allowance for future losses, while still factoring in the actual charge-offs, basically the bad debt, that they experienced right now. In plain English, it tells us how much real, usable capital the business is actively creating today.
And this number brilliantly illustrates their growth. Comparing capital generation year over year, we see a solid bump from $222 million in the second quarter of 2025 to $229 million this quarter. So why does that matter? Well, it proves their core engine is generating more capital today than a year ago, driven by a powerful combination of higher yields on their loans and just overall growth in what's owed to them. To really visualize the sheer scale of their operations, look at their managed receivables, which is essentially the total amount of money owed to the company. That grew a robust 7% year over year, climbing from $25.2 billion to a massive $26.9 billion. Adding nearly $2 billion to your receivables in just 12 months, that points to some seriously strong, sustained consumer demand. And this engine is running fast. Consumer loan originations, meaning the brand new loans they actually issued out to customers, jumped 10% to hit $4.3 billion just in the second quarter alone. That's a huge acceleration. It means their marketing, their physical branches, and their digital platforms are absolutely firing on all cylinders.
Section 3. Time to navigate the credit and risk factors and check for any warning lights.
Okay, these metrics tell a really nuanced story about borrower health. Check out the 30-plus day delinquencies. They're at 5.17%, which is exactly flat compared to a year ago. The 90-plus day delinquencies, also relatively stable at 2.15%. But you have to look closely at the bottom line, net charge-offs. These are the loans they've actually had to write off as uncollectible. They've crept up from 7.19% a year ago to 7.77% this quarter. Now, when you're lending to non-prime consumers, some losses are just part of the game. But an upward trend in charge-offs, that definitely demands our attention.
Because of this little uptick in charge-offs, and because their overall loan portfolio is growing so fast, management is taking some pretty clear protective measures. They proactively increased their provision for finance receivable losses to a whopping $610 million for the quarter. Basically, they're setting aside a much larger pile of cash right now to absorb any future bumps in the road. Sure, it impacts short-term profits, but if you're looking at long-term stability, this is exactly what you want to see.
Moving into Section 4, let's take a look at the balance sheet and liquidity, essentially their safety net. Looking at their $23.1 billion in principal debt outstanding, we can see a very deliberate strategy playing out. Carrying debt is completely normal for a lender, obviously. It's how they fund the loans. But what's super reassuring here is the composition. 52% of this debt is secured. This balanced mix gives them immense operational flexibility. And honestly, it shows that the broader market still has a very strong appetite for OneMain's debt.
And that builds up to their ultimate safety net. Their liquidity is simply massive. We're talking $1 billion ready in an undrawn corporate revolver, $6.5 billion in undrawn conduit and credit card facilities, over $11 billion in unencumbered receivables, plus $567 million in pure cash. What does all that mean? If the financial markets totally froze up tomorrow, OneMain has an enormous war chest to keep operations running without breaking a sweat.
Section 5. The key takeaways and what this actually means for you.
We can neatly summarize this whole earnings report into 4 steps. Number 1, they are highly focused on rewarding shareholders, which we saw with that solid EPS and strong dividend. Number 2, they're successfully growing their core engine, pushing managed receivables up 7%. Number 3, they're actively managing inherent non-prime risks by setting aside that $610 million provision. And finally, number 4, they are protecting the whole operation by maintaining absolute fortress-level liquidity.
So I'll leave you with this final thought. OneMain is clearly operating from a position of structural strength right now, but given the unavoidable macroeconomic headwinds they mentioned in their own report, how will persistent inflation and interest rate pressures truly test the resilience of this balance sheet in the quarters to come? Can the non-prime consumer hold the line in a high-rate environment? That, my friends, is the ultimate question we'll all be watching. Thanks for joining me for this explainer. I really hope this helped clear up the data for you, and as always, keep learning.